Given below is the balance sheet of S Limited as on 31st of March 2020. Equity share capital is provided to us as 100 lakhs and face value of equity share is 10. It means that there are 10 lakh equity shares of rupees 10. Reserves and surplus is 70 lakhs. Land and building is 40 lakhs. Plant and machinery is 90 lakhs. Stock 20 lakhs. Debtors 15 lakhs. Cash and bank 5 lakhs. You are required to work out the value of the company's shares on the basis of it has been given net asset method and profit earning capacity, that is profit earning capitalization method, and arrive at the fair price of the share by considering the following information. So you are required to do three things basically. You are required to compute the fair value, and for the purpose of determining the fair value you have to compute the two values. One is the value based on the net asset. Second, so the value based on the earning capitalization method, and then you are required to compute the fair value. The question says that the profit before taxes for the current year are rupees 64 lakhs including 4 lakhs of extraordinary income and 1 lakh rupee of the income from the investment of the surplus funds. Such surplus funds are unlikely to recur. In subsequent years, additional advertisement expenses of 5 lakhs are expected to be incurred each year. Market value of the land and building, plant and machinery have been ascertained rupees 96 lakhs and 100 lakhs respectively. This will entail additional depreciation of 6 lakhs per year. Income tax rate is only 30%. The capitalization rate applicable to the similar business is 15%. Like that information is given to us. Please go through the question, all of you. So friends, over here we are required to do valuation by two methods. One is called earning capitalization method and another is given a name as the net asset method. Both of them are very simple. In case of earning capitalization method, how we will work out the answer? Let us have a small discussion of the same. We will make the calculation of future maintainable profit. Suppose the future maintainable profit is an amount of rupees 1,50,000. So what happens, let's say we understand like this, that investment and income. It has been given that say the company's required rate of return is 15%. What does it mean? It means that say for 15 rupees of the income, we are ready to invest 100 rupees. Now this company has earning of 1,50,000. So in that case, say what is the current value of the business? That will be found as balancing figure and it will be calculated as 1,50,000 into 100 divided by 15. So here it is 1,50,000 divided by 15%. That comes to an amount of rupees 10 lakhs. So the future earning of the company is discounted in present value term and with that the value of the business is calculated. So we can say something like this. It is earning divided by cost of capital. That is the way we will make the calculation of value of the business. What is the earning? 1,50,000. What is the cost of capital? 15%. So present value of the earning is the value of the business, that is an amount of 10 lakhs. This is what say we are required to do. This is the final process that say we have. And for that say we have to make the computation of this FMP, future maintainable profit. Now for calculation of the future maintainable profit, we understand that say we are required to make the adjustment of first of all the extraordinary item. This 64 lakhs includes this 4 lakhs of income, so that will be deducted. It is after considering the interest income, again that is going to be deducted. Advertisement expenses, that is also going to be deducted. Then there is an additional depreciation of 6 lakhs, that is also supposed to be deducted. If at all there is any extraordinary loss, it would be added. These adjustments will be made in order to compute the future maintainable profit. Then we will make the computation of the discounted value, and then based on that, so the price will be calculated. That is the first way to make, that is the first thing that we are required to do. Afterwards, I'll explain you the second and the third thing, that is valuation based on the net asset method, and the last is I'm going to explain you the fair value. Heading right down. Valuation based on earning capitalization method. In that write down, working note number 1, calculation of number of equity shares. It is equity share capital divided by face value per share. That is an amount of 100 lakhs divided by 10. So it comes to 10 lakhs. Working note number 2, calculation of FMP, future maintainable profit. In the write-down, current EBT is an amount of 64 lakhs. It includes extraordinary income of 4 lakhs. So less extraordinary income, an amount of 4 lakhs. 1 lakh rupee income from the investment of the surplus funds, less income from surplus funds, an amount of 1 lakh. Such surplus funds are unlikely to recur. Good clarification is made in the question, even otherwise we make that assumption. In subsequent years, additional advertisement expenses of 5 lakhs are required to be incurred. So less advertisement expenses. An amount of 5 lakhs. Market value of the land and building is given, plant and machinery is given. That will be useful to us when we will make the calculation of the net asset value. There is an additional depreciation of 6 lakhs. So less depreciation. An amount of 6 lakhs. Income tax rate is given to us So we will deduct all this income from EBT to find a revised EBT. Income tax rate is 30%. So we'll calculate the revised EAT. That is 70%. This is the way we'll make the calculation of the earning after taxes, or we can say it is the future maintainable profit. So the revised EBT will be (64 minus 4 minus 1 minus 5 minus 6). That comes to 48 lakhs. Into 0.7, so it is 33.6 lakhs. This is what's the earning after taxes that we have. Number of equity shares. We have been provided that there are 10 lakh number of equity shares. That will give us EPS 3.36 rupee. So here future maintainable profit per share. The next is the calculation of price per share. It is earning per share divided by cost of capital. We have been provided with the information that the capitalization rate is 15%. So 3.36 rupee divided by 15%. That comes to 22.40 rupee. What does it mean? It means that say for every 100 rupees of the investment, your income is 15. So if at all your income is going to be 3.36 rupee, then what is the price that you are ready to pay for the security is 22.4. Next, heading right down, calculation of net asset per share, or we can also tell that it is net worth per share. That is what we are required to calculate. So over here, friends, land and building, plant and machinery, land and building, plant and machinery, stock, debtors, cash, bank. Stock, debtors, cash and bank. Friends, if at all we have been provided with any liability, it would be subtracted. Total of this is the net asset divided by the number of shares. That will give us the price per share. Okay. We can see that the information is provided to us as market value of the land and building is an amount of 96 lakhs. So this is an amount of 96 lakhs. Market value of the plant and machinery is provided as 100 lakhs. Then the stock value is given to us in the question. 20, 15 and 5. It is 20, 15 and 5. That is where we will find the net asset. So 96 plus 100 plus 20 plus 15 plus 5. That comes to 236 lakhs. Divided by number of equity shares are 10 lakhs. So that is price per share is 23.6. Please write down answer. So now friends, we have computed two prices. One is the price based on the earning capitalization method, and another is the price based on the, we can say that the net asset method. Now we are required to find the fair value per share. Let us understand how to calculate the fair value per share. Price based on earning capitalization method plus price based on net asset method will make the total of both of them, and the same will be divided by 2. In a way that say we can take the simple average, that is 50% importance is given to each of them. Specifically, we have not been given any proportion which should be applied for the calculation of the price. So we'll apply the equal proportion in a simple way. So 22.4 plus 23.6, will add both of them divided by 2. That is the way we'll make the calculation of the fair price. Friends, so far with the working of these questions, all of us have understood. If at all you have the different method of the valuation, then in that case the price of the equity share or the price of the firm is going to change. That is the reason, say number of times we are provided with more than one method of the valuation, and the question would provide us that say you are required to assign certain weightage say to certain method of the valuation. In a way that say suppose say a company wants to give more importance to the earning capitalization than the net asset, then they may provide that the 70% of the weight should be given to earning capitalization method and 30% weight should be given say to the net asset method. If we have been provided with some proportion like this, we have to consider that. If at all no such proportion is provided to us, we will give equal importance to both of them. Please write down a small note for the answer. In calculation of fair price of the security, comma, we may be provided with specific weight to be assigned to individual price, full stop. If no such proportion is given, comma, we may assign equal weight to all prices, full stop.